We're now halfway through a historically bad month for stocks, and they've shown some remarkable resiliency lately. Does that mean we're out of the woods or about to get worse? Let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, with me here at Post 9. It's nice to see you again.
See you.
So we have been resilient. Beginning of the month, we're like, okay, this is a historically bad month, batten down the hatches, and it really hasn't been all that bad. The question is, what happens now? We're halfway through.
Yeah, I think one of the reasons why it hasn't been all that bad is because we have had this lift in earnings estimates. It's been slight for the S&P, but it's actually been rather robust for the NASDAQ. They're up about 9% over the last couple of months. So that's acting as a little bit of a floor under markets, and I think it's one of the reasons why markets have been able to shake off the higher interest rates, which normally would put more downward pressure on valuations.
So you know the obvious question that's coming out of that. Are they too optimistic?
Yeah, well, they might be for 2024. They're also very narrow. That's what's interesting, is that the NASDAQ 100, which itself is a concentrated index, the upside to those earnings estimates is really driven by just three names: Amazon, Meta, and NVIDIA. And even the rest of the Magnificent Seven aren't seeing higher earnings revisions. So just as the market leadership is narrow, earnings estimates are narrow. So it does put the onus for the rest of the market to participate.
Is that the one thing that would cause you to be more cautious, because you just don't believe that earnings are going to come in where they are? You look at other things like rising yields, rising oil prices, a really stunning drop in volatility that, has some saying way too much complacency out there. But what is it for you?
Yeah, I do think that it is an earnings revision down cycle, because all this year flat has been the new up. We haven't seen earnings estimates get cut. They've been raising a little bit. If we go back to a world where earnings estimates start getting cut again, that's looking a lot more like 2022, and that's where you'd say we would expect more than just a short and shallow kind of correction. But if the economy continues to hold up and economic surprises continue to push economic forecasts higher, that's why we're seeing earnings estimates raise.
Yeah, but which side are you leaning on, though? I mean, do you think the economy is going to run out of steam? It surprised so many people. Ken Griffin was on the network yesterday and just talked about the market in general. Wow, there's been so many things that could have gone bad, but they haven't really. And even if they've been a little squirrely here and there, these are my words, of course, not his, but the market's been resilient. It's hung in there, even though he thinks we're in the 7th or 8th inning of this move.
And there's been so many cross currents, because you can point to things like bankruptcies within subprime auto lenders causing you to get scared and think maybe that there's issues with the consumer at the lower end brewing. But then you have the Empire Fed manufacturing survey coming out today showing a big jump in new orders and future expectations. So businesses may be saying, hey, recession averted, we can hire more, we can spend more. So you have all of these contrasting signals all over the place in this market.
Are you in the recession averted camp? I think you were in the recession camp for a while.
No, we were in the no recession in the first half of 23, reassess as we went through it, because we thought that expectations for a recession first half were far too aggressive.
But what about now, though, right?
So,
because, the yield curve is still dramatically inverted.
Yeah.
Right, leading economic indicators still aren't great. Now, you can point to other things that maybe would be the tell of a soft landing or not. But now what, though?
So we don't think that we'll have a recession in 23. So the calls for an entry into recession in the fourth quarter, we don't think are founded by the data. We don't want to rule out a recession at some point in 24, but based on the pace of the data that we're seeing today, it's looking much more like late first half into the second half is the first that we would see it.